Netflix spends $17 billion a year just on content. How does the math even work? That's more than the yearly budget of some entire countries. And yet, Netflix turns a massive profit every single year. So how does a company spend this much and still come out ahead? To understand that, we have to go back to where it all started. Not with streaming, with the mailbox. In 1997, two founders had one simple idea: rent DVDs by mail, no more late fees. It sounded small. It was not. That tiny mail order idea would eventually outgrow an entire industry. Back then, the king of video rental was Blockbuster. Thousands of stores, billions in revenue, total dominance. Netflix once offered to sell itself to Blockbuster for $50 million. Blockbuster said no. That decision would become one of the costliest mistakes in business history. While Blockbuster charged late fees, Netflix built loyalty with flat monthly pricing. Subscribers didn't have to think about return dates anymore. That single change in pricing psychology was worth billions. By 2010, Blockbuster filed for bankruptcy. Netflix had already moved on to something bigger. In 2007, Netflix made its riskiest bet yet. Streaming video, over the internet, on demand. Internet speeds back then were barely fast enough. Investors were skeptical the idea would even work. But Netflix bet the entire company on where the internet was heading. DVDs by mail slowly took a back seat. Streaming became the main event, and the business model quietly started to shift, from shipping physical discs to licensing digital rights. That shift changed where Netflix's real costs would come from. Streaming meant Netflix could reach anyone with an internet connection. Subscriber numbers started climbing fast. By 2013, Netflix had over 30 million subscribers. A decade later, that number would multiply nearly tenfold. Each new subscriber meant predictable, recurring revenue. That predictability is exactly what investors love. A steady subscription model is worth more than one-time sales. But more subscribers also meant Netflix needed more content to keep them. And content, it turns out, is extremely expensive. This is where the real economics of Netflix begin. Netflix makes money almost entirely from subscriptions. No ads for most of its history. Just a flat monthly fee. Multiply that fee by hundreds of millions of people, and you get tens of billions of dollars a year in revenue. That revenue is remarkably predictable, month after month, which makes it easier to plan massive spending in advance. But predictable revenue only works if people keep paying, which means Netflix has to constantly earn that renewal. Every single month, for every single subscriber. That relentless pressure is what shapes everything Netflix spends money on. In the beginning, Netflix didn't make its own shows. It paid other studios for the rights to stream their content. Every show, every movie, came with a licensing fee. And those fees kept climbing every year. Studios realized how valuable their old shows had become. So they started charging Netflix a lot more to renew deals. Worse, some studios began pulling their shows entirely to launch their own competing streaming services. Netflix suddenly faced a serious problem. Rented content could disappear overnight. Netflix needed something it could actually own. The solution was to stop renting and start producing. Netflix decided to make its own original shows. Content it would fully own, forever. No renewal fees, no risk of losing the rights. It was a bigger upfront cost, but a smarter long-term bet. In 2013, Netflix released its first major original series. House of Cards became an instant hit. Critics were stunned, subscribers were hooked, and Netflix realized original content could drive subscriptions directly. So it doubled down, hard. Original content wasn't the only bet Netflix made. It also decided to expand into nearly every country on Earth. By 2016, Netflix launched in over 130 new countries at once. That meant navigating different languages, currencies, and cultures. Local competition existed almost everywhere Netflix went. So Netflix started investing in local, native language shows. A Korean thriller, a Spanish heist drama, a German mystery. Some of these local shows became massive global hits. Squid Game alone was estimated to be worth almost $1 billion in value. Global content wasn't just an expense anymore. It was a growth engine. All of this content had to be paid for somehow, and the budget kept growing every single year, from a few $100 million to several billion. Today, Netflix spends around $17 billion a year on content alone. That's thousands of hours of new shows and movies every year. Some individual shows alone cost hundreds of millions of dollars. That kind of spending only makes sense at a massive scale. Spread across hundreds of millions of subscribers, the cost per person shrinks fast. This is the real secret behind streaming economics: scale. The bigger Netflix gets, the cheaper each show becomes per subscriber. But even with scale, Netflix couldn't pay for everything with cash alone. For years, it borrowed billions of dollars to fund new content. This is called debt financing, and Netflix used it heavily. At its peak, Netflix carried over $16 billion in debt. That's a huge risk if subscriber growth ever slowed down. Investors trusted the bet because growth kept proving them right. Every dollar borrowed was spent chasing more subscribers. And for a long time, that loop kept working. But eventually, Netflix needed to prove it could stand on its own, without needing to borrow more money just to survive. Here's something most people don't realize about Netflix's accounting. When Netflix spends money on a show, it doesn't count as an expense all at once. Instead, that cost gets spread out over several years. This is called amortization, and it changes how profit actually looks. A $100 million show doesn't hit the books as one giant loss. It hits gradually, matched against the years it keeps earning money. This accounting choice makes Netflix's profits look healthier than raw cash spending suggests. It's not a trick, it's just how content assets are valued over time. But it does mean you have to look past the headline profit number to really understand how much cash Netflix is actually spending and earning. None of this works if subscribers keep quitting. That's called churn, and it's one of the scariest words at Netflix. Every subscriber who leaves has to be replaced by a new one, just to break even. Acquiring a new subscriber costs far more than keeping an old one happy. So Netflix obsesses over what keeps people watching. Every thumbnail, every recommendation is designed to reduce churn. Even a 1% drop in churn is worth enormous money at this scale. That's why Netflix built one of the most advanced recommendation algorithms in the world. It doesn't just suggest shows. It protects revenue. Every minute you keep watching is a minute you don't cancel. But Netflix had a massive leak in its revenue for years. Password sharing. Millions of people were watching Netflix without ever paying for it. One account, shared across friends, family, sometimes total strangers. Estimates suggested over 100 million households were doing this. That's 100 million potential paying customers, watching for free. For years, Netflix quietly tolerated it, even calling it love. But as growth started to slow, that tolerance became too expensive. Netflix needed to turn free viewers into paying subscribers. So it made a controversial decision. In 2023, Netflix began cracking down on password sharing. Accounts were tied to a single home address. Sharing outside the household required paying an extra fee. People were furious online. Many predicted it would backfire badly. Instead, something unexpected happened. Subscriber numbers went up, not down. Millions of freeloaders finally created their own paid accounts. In a single quarter, Netflix added nearly 6 million new subscribers. The backlash was loud, but the revenue was louder. It became one of the boldest and most successful bets in company history. Around the same time, Netflix made another huge shift. For over a decade, it had proudly refused to show ads. But cheaper subscribers were still valuable, if paired with advertising. So in 2022, Netflix launched a cheaper, ad-supported plan. Lower price for subscribers, new ad revenue for Netflix. It was a way to capture price-sensitive customers without losing them to competitors. Within 2 years, the ad tier had tens of millions of active users. Advertisers were suddenly lining up to reach Netflix's massive audience. This gave Netflix an entirely new stream of income, one that didn't depend on subscription price increases alone. Speaking of price increases, those happened constantly too. Every year or two, Netflix quietly raised its subscription prices. A few dollars here, a few dollars there. It rarely caused mass cancellations, because Netflix had become deeply embedded in people's daily routines. Canceling Netflix started to feel like giving something up, not saving money. That kind of loyalty is called pricing power, and it's incredibly valuable. Each small price increase, multiplied across hundreds of millions of subscribers, adds up fast. Even a $1 increase can add over $1 billion a year in revenue. That's the quiet mathematics behind every price hike announcement. Of course, Netflix isn't operating alone in this space. Disney launched its own streaming service in 2019. Backed by decades of beloved franchises and characters, Amazon bundled its streaming service with fast shipping, hiding the real cost. HBO leaned on prestige dramas and blockbuster theatrical releases. Suddenly, the streaming wars had real competition and real spending battles. Every company started spending billions just to keep up. For a while, it looked like a race that nobody could actually win. Some competitors lost billions of dollars trying to catch up. Netflix had a head start that turned out to be almost impossible to close. But 2022 forced Netflix to rethink its endless spending spree. For the first time in a decade, Netflix actually lost subscribers. The stock price crashed by more than 70% that year. Investors panicked, wondering if the growth story was finally over. Netflix had to prove it could grow profit, not just subscriber count. So it started spending more carefully, cutting underperforming shows early. Fewer expensive flops, more calculated bets. Data on viewing habits helped Netflix decide what to greenlight and what to cancel. It wasn't about spending less forever, just spending smarter. That correction became one of the turning points in Netflix's financial story. All these changes led to something Netflix had never consistently achieved before: positive free cash flow. That means Netflix finally generated more cash than it spent. For years, it had been the opposite, burning cash to grow. Now, Netflix could pay down its debt instead of adding more. It even started buying back its own stock. A clear signal that Netflix believed in its own long-term value. Profit margins climbed to levels few streaming companies had ever reached. Netflix had transformed from a cash-burning growth story into a profit machine, and Wall Street finally started to trust the model again. Let's go back to something crucial: local content investment. Making shows in Korea wasn't just a cultural choice. It was financial strategy. Korean productions often cost far less than American blockbusters. Yet they could become massive hits watched all over the world. That's an incredible return on a relatively modest investment. India, Brazil, Nigeria all became key growth markets too. Billions of potential subscribers live in these fast-growing regions. Even at lower price points, that scale adds up to serious revenue. Local content also keeps subscribers loyal in competitive markets. Global scale built one local hit at a time. Netflix didn't stop at shows and movies, either. In 2021, it quietly launched a mobile gaming division. Games included with a regular subscription, no extra charge. The goal wasn't to compete with major gaming studios directly. It was to add even more reasons never to cancel your subscription. More value packed into the same monthly price. So far, gaming remains a small part of the business. But it shows how Netflix keeps experimenting to protect its core subscription. Every new feature is really just another retention tool, games included. Netflix also started testing something it once said it would never do: live events. Streaming has always struggled with truly live content, unlike traditional broadcast. But Netflix took the risk anyway, starting with boxing and comedy specials. Then it landed a bigger prize: NFL games on Christmas Day. Tens of millions of people tuned in at once. Live sports brings something Netflix rarely had: appointment viewing. People who watch live are far less likely to cancel their subscription. It also opens the door to premium advertising deals around big events. Live sports could become Netflix's next major growth chapter. Behind every decision Netflix makes, there's an enormous amount of data. What you watch, when you pause, even when you rewind. All of it feeds into decisions about what to spend money on next. Even the thumbnail image you see can be personalized just for you. Small changes like that can shift viewing numbers by huge margins. This data also tells Netflix which shows to renew and which to cancel. A show with passionate but small viewership might still get canceled. Because at Netflix's scale, passion alone doesn't justify the cost. It's a cold, data-driven business wrapped in creative storytelling. Every emotional story you love is backed by a spreadsheet somewhere. All of this plays out very visibly in Netflix's stock price. Every quarterly earnings report can send the stocks swinging wildly. A small miss in subscriber growth once wiped out billions in market value overnight. Investors treat subscriber count almost like a heartbeat monitor. Any irregular beat, and the whole market reacts instantly. That's why Netflix eventually stopped reporting subscriber numbers as the main metric. Instead, it shifted focus toward revenue and profit margins. A subtle move, but one that changed how Wall Street judges the company. Fewer wild swings, more focus on long-term financial health. At least, that's the story Netflix wants investors to believe now. None of this happened by accident. It started with two people and an idea. Reed Hastings co-founded Netflix after getting hit with a late fee himself. Whether that story is exactly true or a bit of legend, the frustration was real. Hastings pushed Netflix to constantly reinvent itself, even when it was working. From DVDs, to streaming, to originals, to ads, to games, to live sports. Each shift risked the business that came before it. That willingness to cannibalize its own success became Netflix's biggest advantage. Most companies protect their old business model until it's too late. Netflix demolished its own model again and again before anyone forced it to. That culture of self-disruption is baked into every financial decision Netflix makes. Netflix's internal culture also shaped its financial decisions. The company famously operates on a principle called freedom and responsibility. Employees get enormous freedom to make big spending decisions on their own. No lengthy approval chains slowing down a $100 million deal. That speed let Netflix outbid competitors before they even finished discussing a deal. But that freedom also means bigger, faster mistakes are possible. Netflix accepts those costly mistakes as the price of moving fast. A few expensive flops are worth it if the big bets keep paying off. This high-risk, high-reward mindset runs through the whole company. It's a culture built for a business defined by expensive, uncertain bets. Of course, this whole model comes with serious risks. Content costs keep rising faster than inflation almost every year. Talented actors, writers, and directors know exactly how valuable they are. Competition for the best ideas has never been more expensive. And competitors aren't standing still either. Disney, Amazon, and Apple all have deep pockets and long-term patience. Any of them could outspend Netflix for years without needing streaming to be profitable. That's a very different kind of competitor than a normal business rival. Netflix has to keep winning on execution, not just spending power. One misstep in this environment could be very costly, very quickly. So where does Netflix go from here? More advertising revenue is almost certainly part of the plan. More live sports and events are likely to follow the NFL's success. Gaming could quietly grow from a side project into something bigger. Password sharing revenue has mostly been captured already. So future growth will likely come from new formats, not old loopholes. Price increases will probably continue too, carefully and gradually. As long as subscribers keep finding enough value to justify the cost. That balance between spending, pricing, and value is the entire game. It always has been. Let's step back and look at the full picture. $17 billion spent on content every year. Nearly 300 million paying subscribers worldwide. Almost $40 billion in annual revenue. Billions in profit, and finally, positive free cash flow. A crackdown on password sharing that actually backfired in Netflix's favor. A brand new advertising business built from scratch. Bets on games, live sports, and global local content. All built on top of one simple idea, a flat monthly subscription fee. That simple idea grew into one of the most complex media businesses on earth. Netflix's economics aren't really about movies and shows at all. They're about scale, retention, and relentless reinvention. Every big spending decision comes back to keeping subscribers paying. Every risky bet is really a bet on staying essential to daily life. That's a business built to constantly justify its own existence. Month after month, subscriber after subscriber. Netflix didn't just change how we watch television. It rewrote the entire economics of entertainment itself. And it's still rewriting them, one quarter at a time. That's the real story behind the price of your monthly subscription.